What's going on, everybody, and welcome back to yet another video. In today's video, I want to share with you guys the easiest way to grow a small trading account by trading SPY and QQQ. And honestly, you can even apply this to futures, trading ES and NQ. But real quick, as always, if you guys do find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. Okay, so the way that you are going to grow a small trading account, and the easiest way to grow this small trading account, is by trading supply and demand. Now, supply and demand is very, very complex, but I'm going to break down everything you need to know about it in this video. So a supply zone is where unfilled sell orders are sitting in the market. So your supply zones are going to act as an area of resistance. Demand, on the other hand, is an area of unfilled buy orders, which is going to act as support. Now, the reason why these areas act as resistance and support is because think about this. Imagine you're a very large hedge fund trying to get short in the market and price moves very quickly away from your level. These hedge funds are not going to chase price. They're going to leave their orders there and they're going to wait for price to come back, fill their orders, and then make that move down if the orders are large enough. Same thing as demand. Imagine you're a large fund trying to get long and price moves very quickly to the upside. They're not going to chase price to the upside. They're going to leave their orders there waiting to get filled. So when that happens, the next time price comes back and either tests a supply zone, we're looking for a reject in that area. So we're looking for puts if we're trading SPY or QQQ, or if we're trading futures, we're looking for shorts. Or if price comes down to the demand zone, we're looking for this to become support and we're looking for calls on SPY or QQQ. Or if we're trading futures, we're looking for longs to then catch that move up. So again, these are areas of unfilled buy and sell orders. And when price goes back to that area, we either want to be looking for bullish price action or bearish price action to confirm the trade and then take it. Now, here's the thing. We don't simply want to short just because price comes up into supply, and we don't simply want to go long or buy calls because price comes down to demand. There's a lot more to it that we need to understand. But first, I want to show you guys how to actually draw these zones. Okay, so when we are looking for demand to be formed in the market, there are two things that we want to look for. The very first thing that we want to look for is we want to look for a small red basing candle. It has to be red. If it's not red, this does not count. So a smaller red candle. After that, we want to look for a very large and aggressive move to the upside, and we need this to be a green candle. So again, a smaller red candle before a very large aggressive move up. This is going to signify that there are unfilled buy orders sitting down in this area. So now once we have identified these two things, in order to plot our demand zone, there's actually two different ways, and I'll show you guys how to plot both of them. But what I do is I mark the high of that red candle, so the upper wick area right here, and I also mark the opening of the body. This is going to give us two exact areas to watch the next time price comes down into this demand zone to look for a bounce. So we're either going to watch the wick, or if price goes deeper, we're going to watch the body. Now, obviously, price could bounce anywhere in the demand zone, except personally, I have found that the wick or the body gives us the highest probability of a reaction. So we're going to mark the wick, we're going to mark the open of the body, and then depending on where the green candle wick is, if the green candle wick is lower than the red candle wick, we are going to mark that level. Now, if the green candle wick is smaller than the red candle's wick, we're actually just going to go ahead and we're going to mark the red candle's wick. So this would then become our demand zone, or if the green candle's wick was lower, this would then become our demand zone. So from there, what I do is I plot that lower wick all the way up into the body, and then this is going to be my demand zone. And I'll show you guys some examples of this here in a little bit, but this is going to be our demand zone. This is where the unfilled orders are sitting in the market. So when price trades down into this area, we are looking for it to become support. And when price is trading in demand, I do not care about shorts whatsoever. The only thing I care about is longs or calls on SPY and QQQ. And we need to get the reaction in order to take the trade. So if we came down and got a bullish reaction, that is signifying to go long. And then we are going to place our stop loss on the opposite side of the entry candle. Now, as far as supply, what we are looking for is we need a small green candle. And then right away after that small green candle, we are looking for a very large aggressive flush to the downside. So this candle needs to be red. So the setup is going to look something like this. Now, what this is showing us is that there are unfilled sell orders in the market. Again, anybody who is looking to get short right here, because price made a very quick and aggressive move to the downside, this leaves unfilled sell orders. So the next time price comes up and trades in this area, we are looking for it to become resistance. Now, in order to mark your supply zone, again, there's a couple ways that I go about it. I will mark the upper wick, the open of the body, as well as the lower wick. Again, this gives us more of a direct area to watch, the open of the body and that lower wick. And that's personally where I've noticed the most reactions happen. But if this red candle's wick is higher than the green candle's wick, we are simply going to mark that instead. So then from there, we take our rectangle, we mark the upper wick all the way down to the lower wick, and this is going to be our supply zone. So now the next time that price comes up and trades in this area, again, we are looking for it to become resistance. We're looking for bearish price action in this general area. And if we get a bearish reaction, we will look to take a short with a stop loss right above the entry candle. So that is how you go about plotting your supply and demand zones, and why these areas actually work. Because again, these are very large funds leaving orders in the market waiting to get filled. And when they actually go and hit those orders or get near those orders, that's typically where we see a very large reaction in the market. So now let me show you a demand zone that actually played out very recently. So if we pull up this chart on NQ and we go to the 2-hour time frame, you can see that on the 2-hour over here, we have this small red candle before a very large aggressive move to the upside. So now in order to plot this demand zone, what you're going to do is, because this green candle's wick is lower than the red candle's wick, you're going to mark that portion first. You're then going to mark the open of that red candle right there. And then you're also going to mark the upper wick right here. So now once you have those three plotted, you'll simply take your rectangle and draw it from this lower wick to the red candle's upper wick right there and project this forward. So now this is our demand zone. So the next time price comes down to either this upper red candle's wick right there or the open on the body, we're going to be looking for a reaction. Now, if we go back to last Wednesday, you can see that price went right down into the very beginning of that demand zone, made it support, and that was the dead bottom of last week before rallying back up into a new all-time high. Now, as far as a supply zone, you can see that this one got very, very close. Maybe it hit it on a 2-hour. Let's see. Yeah, so it did hit it literally to a point on a 2-hour. So if we go to the 2-hour right here, we have a very small green candle right here before a very large flush to the downside, leaving unfilled sell orders. So what we are going to do is we are going to mark the high of this red candle here to the lower wick of this green candle right here and simply project this forward. Again, this is a 2-hour supply zone. So now as price trades up into that level, this was about like 2 Thursdays ago, you can see that it literally hit it to a point, an elevation in the volume showing that sell orders were getting filled. And that was the exact high of day before price flushed all the way from 20593 all the way down into 20365. And again, you can take advantage of this through SPY and QQQ options, or if you trade futures, you can take advantage of it through ES and NQ. And like I said, I personally think that this is by far the easiest way to trade, because these are very large buy and sell orders in the market waiting to get filled. And we will typically see a pretty large reaction when we hit these zones and get the confirmation to take the trade. So if you guys would like more videos on supply and demand, make sure to drop a comment down below. And if you guys haven't already, make sure to hit that like button, as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. We're getting super close to 100K subscribers. So every single one of you that subscribed today, I greatly appreciate you. Actually, everybody that subscribes in the future. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.